You're about to join into the world of systematic market cycles. Learn the most dependable and consistent, yet often overlooked investment strategy. Welcome to the Technical Intrinsic Value Podcast.
Usually when we talk about financial markets, there's this expectation of chaos, right? A kind of unpredictable frenzy.
Oh, absolutely.
You turn on the cable news and you see the ticker tape flashing red and green and pundits yelling about the latest crisis. It just feels like this giant randomized casino where anything can happen on any given day. You look at your portfolio and it feels like it is just twisting in the wind, completely at the mercy of whatever headline drops next.
Right. It feels totally reactive. I mean, if you are just watching the surface level price action, it seems completely untethered from any underlying logic.
Untethered. Exactly. Sure. But then you step into the world of quantitative market history, and suddenly that chaos starts to look like a highly choreographed dance. Because we are looking at a specific financial landscape today that is, and I do not use this phrase lightly, mind-blowing.
It really is.
When we dig into the data, we find that since 1950, there is a specific market phenomenon, like a mechanical cyclical event, that has had a 100% win rate, a perfect record over 19 separate cycles.
It is the absolute definition of a statistical anomaly hiding in plain sight. It is binary, it is undefeated, and yet it gets completely drowned out by the noise of the daily news cycle.
Okay, wait, I have to push back right out of the gate here. 19 for 19. In finance, nothing is 100%. If it is that reliable, why hasn't Wall Street arbitraged this away completely? Are you saying all the quantitative funds, the massive institutional players, just ignore this?
No, they do not ignore it at all. In fact, their behavior is exactly what creates it. That is the irony here. The 100% win rate isn't some magic glitch in the matrix. It is the mathematical result of human institutional behavior playing out the exact same way over and over every 4 years.
Wow. Okay, that is exactly what we are going to unpack. Welcome to the Technical Intrinsic Value Podcast for our deep dive into the underlying mechanics of the market. Today, our mission is to cut straight through the political noise of the election year.
Yeah, we are going to look at the rigorous historical data and the quantitative research of Nicolau Primavera Carvalho. He is the creator of the Technical Intrinsic Value, or TIV, model.
Right, and just to be clear, everything we discuss today, every data point and every historical regime is sourced directly from his research on macro political equity regimes.
And it is a framework that completely shifts how you view volatility. When you understand the machinery underneath, it takes the emotion out of the equation.
It really does. And before we get into the heavy math, I want to let you, the listener, know that Nicolau's Technical Intrinsic Value book is currently available on Amazon. If you want to understand these market cycles, it is a fantastic resource.
Absolutely.
Furthermore, for those of you listening who want to truly master this TIV model, there is a waiting list right now at www.technicalintrinsicvalue.com for Nicolau's exclusive live program. It is capped at a maximum of just 5 students, so if you're a professional or a deeply committed analyst wanting to go deeper into this, that is where you need to go.
Yeah, it is a really rare opportunity to look under the hood of a 70-year historical edge.
So let's set the tone for today. Think about how you feel right now. How do you feel when you look at your portfolio during an election year? If you are like most people, you are probably stressed. You see the headlines, you see the shifting polls, you hear the doomsday predictions from both sides of the aisle.
And that anxiety is entirely by design. The headlines are engineered to provoke an emotional reaction because that is what drives viewership. But what we are going to do today is replace that political anxiety with cold, hard mathematics.
I love that.
We are going to look at the structural mechanisms that actually move capital.
Let's start with the baseline. If you look at non-election years, the S&P 500 yields a fairly steady, relatively calm average return of around 7.8%. It is the market doing what the market historically does. It prices in earnings, it adjusts for moderate economic shifts, and it grinds upward.
Yeah.
But midterm years are an entirely different beast. Nicolau calls it the midterm capitulation. The first half of a midterm year is characterized by this violent, agonizing chop.
Violent chop is the perfect way to describe it. It is not a straight, clean line down. It is a grinding, highly volatile, sideways to downward movement that shakes out a tremendous amount of retail investors.
The data on this drawdown is staggering. Since 1950, the average intra-year pullback during a midterm year is a painful negative 16.3%.
This is massive.
And some of the models in Nicola's research show that peak-to-trough drop hitting an average of negative 17.1%. This is not just a minor dip. This is a structural capitulation. Let's actually pause and look at a recent example to make this concrete. Look at 2022.
Yeah, 2022 is a textbook example of the midterm capitulation amplified by external factors. We saw a massive negative 25.4% drop before the market finally found its footing.
Right. And if we do a post-mortem on 2022, what were the headlines saying? The narrative was terrifying.
Yep.
Inflation was hitting 40-year highs. The Federal Reserve was hiking interest rates at the fastest pace in decades.
Exactly.
We had the outbreak of the Russia-Ukraine war, which sent energy and commodity prices skyrocketing. And then on top of all of that, you had the midterm elections looming. Retail investors were panicking. They were looking at their retirement accounts shrinking by a quarter, and they were selling out of pure fear. But the institutions weren't panicking in the same way, were they?
No, they were not. And that brings us to the core mechanism. To understand why this 16 or 17% average drop happens so reliably, we have to look at institutional behavior through the lens of what is called the Keynesian precautionary motive.
Okay, let's unpack this, because Keynesian precautionary motive sounds incredibly academic. Translate that for us.
Sure. The underlying psychology is actually very intuitive. It goes back to John Maynard Keynes, who identified that entities hold cash for a few specific reasons. One is for transactions, just paying the bills.
Right, makes sense.
Another is speculative, keeping cash on hand to buy an asset if the price drops. But the third, the precautionary motive, is all about holding cash as a buffer against unforeseen future events.
Like an emergency fund.
Exactly like an emergency fund, but on a macroeconomic scale. Why do markets drop in the first half of a midterm year? It is not necessarily because bad things are actively happening in that moment.
Okay.
It is because institutional capital, the trillions of dollars managed by pension funds, hedge funds, and corporate treasuries, is suddenly facing a massive unknown.
When you say an unknown, you mean the political landscape.
Yeah.
Because they do not know who is going to win control of Congress.
Precisely. Financial markets are incredibly efficient pricing machines. They can price in bad news all day long. If interest rates are going up, as they were in 2022, the quantitative models simply run the math, discount the future cash flows at a higher rate, and adjust the asset price down.
So they just adjust the formula.
Yeah. If there is a minor recession projected, they adjust the earnings multiples. Markets can handle bad news because bad news has quantifiable parameters. What markets absolutely cannot handle, what they cannot price in, is a blank slate.
A blank slate. Give me an example of how that plays out in a corporate boardroom.
Think about it from the perspective of a corporate decision maker, say, the chief financial officer of a major multinational corporation. You are sitting in a boardroom in March of a midterm year. You are staring down an election in November.
Okay, I'm with you.
You have $1 billion allocated for a new manufacturing plant or a massive software upgrade, but you do not know what the tax code will look like next year. Will corporate taxes go up or down? Are we looking at massive regulatory shifts in the energy sector or the tech sector?
Right. In the first half of a midterm year, all of those inputs in your financial models are essentially just giant question marks.
Exactly. Will there be new antitrust enforcements? Will government spending in your sector dry up or expand? And because they cannot run the math, they hit the pause button. Nicola's research highlights a very specific quantitative corporate cash analysis here. It shows that as political uncertainty rises, the sensitivity of cash holdings to standard cap flows actually decreases. He uses a calculus derivative to explain this.
Oh boy.
Yeah, the second derivative of cash with respect to cash flow and political uncertainty is negative.
Whoa, okay, let's translate the calculus for a second because we do not want to lose anyone here. When you say the second derivative is negative, what does that actually mean for the money moving around in the market?
Think of the first derivative as the speed at which a company is accumulating cash from its operations. The second derivative is the acceleration or deceleration of that hoarding behavior. What the negative second derivative means is that as political uncertainty goes up, corporate managers actively change their behavior to conserve cash faster.
Oh, I see.
They stop caring as much about deploying their operating cash flows into new projects, and instead, they just hoard it. They delay major capital expenditures, they delay hiring.
So they are essentially starving the economy of investment because they are waiting to see what happens.
Yes, exactly. This directly slows down near-term economic growth, and it pulls the corporate investment bid right out of the market. And institutional asset managers do the exact same thing.
Really?
Yeah. Empirical data shows that during major election years, these institutional investors reduce their equity exposure by 0.8 to 2.3 percentage points.
That might not sound like a lot to a retail investor like 1 or 2%.
Yeah.
But when you are talking about trillions of dollars under management, a 2% reduction in equity exposure is a massive tidal wave of selling pressure. They just take that money out of stocks and put it where?
They redirect it toward liquid cash equivalents, money market funds, short-term treasuries, or sometimes international instruments like American depository receipts that are insulated from U.S. domestic politics. They are paying for insurance.
Okay.
In fact, this hedging behavior drives up implied volatility.
Let's define implied volatility for those who might not trade options.
Sure. Implied volatility is essentially a metric that shows how much the market expects a stock or an index to move in the future. It is derived from the price of options contracts. When institutional investors get nervous about an upcoming event, like an election, they buy put options to protect their portfolios against a crash.
Like a safety net.
Right. And because so many massive funds are buying this insurance at the same time, the price of those options goes up.
The insurance premiums get more expensive.
Exactly. The market's implied equity risk premium spikes. You see, options pricing for major equity index contracts gets significantly more expensive in the months leading up to November. The entire institutional landscape goes into a defensive crouch.
But wait, this brings me back to my earlier pushback. If everyone on Wall Street knows this dip happens every 4 years, if the data since 1950 is sitting right there in front of them, and they know the average drop is 16%, why do they not just buy the dip earlier?
It is a fair question.
Why let the market drop that far? It is like driving on a highway you commute on every single day. If you know the road is usually safe and there aren't any sunny cliffs, why are you slamming on the brakes just because it's an election year?
That highway analogy is actually perfect, but let's tweak it to fit the reality of the market. Let's say you are driving that familiar road, you know it well, but suddenly a thick, impenetrable fog rolls in. You literally cannot see 10 feet in front of your bumper.
Okay, I am with you. The fog is the political uncertainty.
Right. Now, it does not matter that you know the road is usually safe. It does not matter that you know you drove it yesterday without a problem. The sheer lack of visibility forces you to hit the brakes. You are acting out of self-preservation because the risk of an unseen obstacle, in this case, a radical legislative change, is too high to ignore.
Because if you do not hit the brakes and you hit a stopped car in the fog, you're dead.
Exactly. And in the financial world, if you are managing $10 billion of pension money, your fiduciary duty demands that you slow down in the fog. You cannot risk your client's capital on a guess about what the next Congress will do.
That makes total sense.
If you guess wrong, and a new regulatory regime wipes out a sector you are heavily invested in, you lose your job and your clients lose their retirement. So you hit the brakes, you hoard cash, and you wait for the fog to lift.
That is a phenomenal way to visualize it. The liquidity vacuum is not an accident. It is a calculated defensive maneuver. And the tragedy here is that millions of retail investors panic and sell at the very bottom of that 17% drawdown, which just adds fuel to the fire.
Absolutely.
The retail guys are selling out of emotion and fear, while the institutions are stepping back out of mathematical precaution. So if the market is hitting the brakes to hoard cash, we need to look at what exactly they are afraid of in Washington. What are they trying to see through the fog? What historical pattern are they banking on to eventually unlock that capital?
This is where the political reality and the financial reality intersect in a very counterintuitive way, and it revolves around the concept of gridlock.
Let's lay out the undeniable historical trend here regarding midterm elections. We have 23 midterm election cycles in the primary data set, and the trend is brutal for whoever is sitting in the Oval Office. In 36 of the last 39 midterm elections, the incumbent president's party loses congressional seats.
36 out of 39, that is an overwhelming statistical probability.
It is basically gravity at this point. On average, the president's party loses 27 seats in the House of Representatives and 3 seats in the Senate. Nicholas' research notes that exceptions are incredibly rare.
Very rare.
Since the Great Depression, the incumbent party has only picked up House seats 3 times. 1934 under FDR, 1998 under Clinton, and 2002 under George W. Bush.
And notice the context of those 3 exceptions. They only occur during massive, once-in-a-generation crises or historic, roaring economic expansions. 1934 was the rollout of the New Deal during the Great Depression. 1998 was the peak of the massive dot-com economic boom. 2002 was the aftermath of 9/11, where the country rallied around the president. In every other normal environment, the incumbent gets punished.
The classic two-year itch. The electorate's approval rating for the president almost always dips by year 2, and the opposition party's voters are historically much more motivated to show up at the polls to register their dissatisfaction.
Yeah.
Now, before we go any further into the politics of this, we need to make an ironclad, explicit disclaimer to you, the listener. We're completely impartial here. Nicola's research is completely impartial.
Yes, absolutely.
The data we are looking at does not care if you vote blue, red, independent, or if you do not vote at all. The data clearly shows that the market does not care if the policies coming out of Washington are left-wing or right-wing.
The market has no political affiliation. It has no ideology. It only has a risk-return mandate. It only cares about 2 things: certainty and capital constraints. Does the policy landscape allow corporations to accurately forecast their earnings? And does the legislative environment make the cost of capital cheaper or more expensive? That is it.
We are looking at the math, not the morality. So with that incumbent loss trend established, we get to this fascinating debate that Niccolo highlights in his work. It is the debate between Wall Street practitioners and academic researchers on the concept of gridlock.
This is one of the most interesting divergences in financial theory. The people trading the money on the floor and the people studying the money from the ivory tower have arrived at 2 completely opposite conclusions about what kind of government is best for the stock market.
Let's deal with Wall Street's view. If you walk onto a trading floor, the conventional wisdom that gridlock is great. A divided government where one party holds the White House and the other holds at least one chamber of Congress is viewed as the absolute best case scenario.
And they have the data to back it up.
Exactly. Looking at the historical data since 1928, a divided government yields a 13.5% average return for the S&P 500 compared to an 11.4% return for a unified government. Why? Because legislative stalemates mean inertia. If Congress is gridlocked, there are no surprise corporate tax hikes. There are no radical, sweeping regulatory changes. Everything just stays the same.
And for a large-cap multinational corporation, stability is the ultimate premium. If you are Apple or Exxon or Johnson & Johnson, you have massive legal teams and accounting departments that have already optimized your business for the current laws.
Right.
A gridlocked Washington means you do not have to spend billions of dollars restructuring your operations to comply with a new regime. The status quo is highly profitable for large-cap companies, and gridlock protects the status quo.
But then you walk onto a university campus, you talk to the academic researchers, and they say Wall Street is entirely wrong. Academia's view, based on long-term historical studies from 1927 to 2017, is that a unified government is actually far better for long-term economic growth and stock returns.
What is fascinating here is the magnitude of the difference.
Yeah, they look at value-weighted excess returns, and they found that unified governments produced an average annual excess return of 10.7%. Divided governments, just 0.8%. That is a massive, statistically significant difference of nearly 10%.
It is a stunning divergence in the data. And the gap is even wider if you look at equal-weighted stock portfolios rather than market cap-weighted ones. Equal-weighted portfolios show a 17.5% return under unified governments versus a negative 0.9% return under divided governments.
Wow.
And the macroeconomic data backs the academics up, too. Average post-war annual real GDP growth hits 4.2% under unified governments compared to just 2.6% under divided ones.
So who is right? How do we have 2 sets of brilliant people looking at the same history and getting completely opposite answers?
They are both right, but they are looking at different parts of the corporate ecosystem. Nicola's research reconciles this brilliantly by bringing in the Fama-French small minus big, or SMB, premium strategy.
Okay, let's unpack this. For those who aren't familiar with Eugene Fama and Kenneth French, they are incredibly famous financial economists who created models to explain stock returns. What is the SMB concept?
The SMB strategy essentially tracks the return difference between small-cap portfolios and large-cap portfolios. Fama and French noted that, historically, smaller companies tend to outperform larger companies over the long run, but with higher risk.
Okay.
What the academic research reveals in relation to the political cycle is that, while massive, cash-rich companies love gridlock, smaller, more highly leveraged companies get absolutely crushed by it. Across the government cycle, the SMB strategy shows an average annual return gap of 7% in favor of unified governments.
Why do small caps hate gridlock so much? Give me a concrete scenario.
It comes down to the cost of capital. When you have a divided government, you inevitably get political theater. You get debt ceiling standoffs. You get government shutdowns. You get budget battles that drag on for months. These legislative standoffs introduce macro instability, which increases Treasury risk premiums. Interest rates get volatile.
And how does that affect different companies?
Let's compare two companies. On one hand, you have Apple. Apple is sitting on roughly $160 billion in cash and marketable securities. If Congress shuts down the government for a month over a budget dispute and Treasury yields spike, Apple's CEO does not care. It is just annoying news on the TV in the corporate lobby.
Right, they self-fund their operations.
Exactly. They do not need to borrow money to make payroll. In fact, they might even make more interest on their cash pile.
So they're totally insulated.
Now compare that to a small regional logistics company. They operate a fleet of 100 trucks. They do not have billions in cash. They rely heavily on revolving credit facilities and floating rate short-term debt to buy fuel, maintain their trucks, and make payroll.
Oh, man.
When Washington gridlocks and the debt ceiling standoff causes short-term borrowing costs to spike, that regional logistics company feels the pain immediately. Their interest expense shoots up, their profit margin is wiped out. If the gridlock drags on, they freeze hiring, or worse, they lay people off. That gridlock is lethal to them.
Because their borrowing costs are spiking while Washington argues over the budget.
Exactly. Gridlock acts as a persistent structural headwind for small cap equities. The policy inertia and the rising cost of capital choke off their growth. So, Wall Street loves gridlock because Wall Street indexes, like the S&P 500, are market cap weighted.
Right.
They are dominated by mega cap giants who thrive on stability and are immune to credit crunches. Academia prefers unified government because they are looking at the broader, equal weighted economy where small businesses need a functional government to keep credit markets smooth and GDP growing.
That is such a crucial distinction. It really highlights how you cannot just look at the market as one giant monolith. You have to understand the internal dynamics and the capital structures of the companies inside it. But regardless of whether we end up with gridlock or a unified sweep, something magical happens the moment the votes are finally tallied.
That is the turning point.
Once the outcome is known, the fog we talked about earlier, it lifts. And this sudden clarity, this transition from the unknown to the known, is the trigger for the most reliable phenomenon in modern finance.
This is the core thesis of Nicola's analysis, and it is where the data gets truly extraordinary. Because once that fog lifts, the institutional capital that was hoarded on the sidelines has to go somewhere.
Listeners, lean in for this part. We mentioned it at the top of the deep dive, but let's lay out the exact payoff. In the 19 midterm elections since 1950, the S&P 500 has been higher 12 months after the election exactly 19 times, a perfect 100% win rate.
It is wild.
And we are not talking about eking out a 1 or 2% gain. The average 12-month forward price return is 15.4%, and the average total return, which includes reinvested dividends, is an incredible 18.3%.
To put that in perspective, the broader long-term historical average return for the market is roughly 10%. So you are getting almost double the average historical return in this specific 12-month post-election window.
And even if you want to be a skeptic and say, well, the post-war era is a unique economic period, maybe it's a fluke, Nicolaus' research extends the dataset all the way back to the pre-war era, back to 1928. Over 125 years of tracking 31 midterm election cycles, the S&P 500 advanced in the 12 months following a midterm election 92% of the time.
The only times it failed were during massive, earth-shattering exogenous shocks like the Great Depression.
Right. But for the modern era, 1950 to 2022, it is a flawless, undefeated streak.
We can look at the specific years in the research to see just how resilient this streak is. It holds up even during the most terrifying macroeconomic conditions. Take 1974, for example.
Oh, wow. 1974 was a brutal year. Paint the picture for us.
In 1974, the U.S. was dealing with severe stagflation, high inflation, and stagnant economic growth. You had the OPEC oil embargo, which quadrupled the price of oil and caused literal gas lines around the block.
I remember hearing about that.
Politically, you had the Watergate scandal reaching its climax, leading to Richard Nixon's resignation in August. The market suffered a devastating 35.9% intra-year pullback. It felt like the end of the world financially.
People must have been completely dumping equities.
They were. But if you look at the math of the cycle, the market bottomed in October of 1974. Measured from election day in November, the one-year forward total return for the S&P 500 was 24.1%.
Wait, really?
Yes. The underlying mechanics of the cycle overpowered the macroeconomic trauma.
What about 2002? Another terrible year. The dot-com bubble had burst the year before, wiping out trillions in tech valuations. We had the Enron accounting scandal destroying trust in corporate America. We were in the aftermath of 9/11, leading up to the Iraq War. The market drew down 33% that year.
Same story. The market bottomed in October, right before the midterms, and the one-year forward return from Election Day was 16.6%.
And we already talked about 2022. Inflation hitting 40-year highs, the Fed raising rates aggressively, the Russia-Ukraine war, the S&P 500 dropped 25.4% peak to trough. People were terrified that the Fed was going to engineer a massive recession. And yet, what happened?
The 12-month forward price return from the 2022 midterm election was 20.0%. The cycle held, the fog lifted, the institutional risk models recalculated based on the new congressional makeup, and the capital returned.
It is incredibly consistent. But as an investor, you cannot just passively buy the index and go to sleep if you really want to maximize this cycle. Nicola points out that you have to watch where the smart money flows. You have to understand the internal rotation of capital.
Yes, the great sector rotation. This is how you differentiate between just surviving the midterm year and truly capitalizing on it, because the money does not just flow back into everything equally. Sector leadership follows a highly structured, almost choreographed path. It moves from defensive positioning before the election to cyclical growth afterward. Let's break down the pre-election phase, the first half of the year. We said earlier that institutions are hoarding cash, but the equity exposure they do keep in the market is not just randomly distributed. They hide in defensive sectors.
That is right. From January through Election Day, the historical data shows that energy leads all S&P 500 sectors, averaging a 7.9% return. Healthcare is the second best performer, averaging a 6.5% gain.
Exactly.
For the listener who might be newer to sector analysis, what makes a stock defensive? Why those specific sectors?
It is all about the elasticity of demand. Defensive sectors are businesses that provide goods or services that people absolutely have to buy, regardless of the broader economic conditions or who is sitting in Congress. People still need to heat their homes, put gas in their cars, and buy their prescription medications.
That makes total sense.
If you have a heart condition, you are buying your medicine, whether the economy is booming or in a recession. These companies also tend to offer high, stable dividend yields. So institutional capital parks in these sectors as a precautionary measure. It provides a steady return and hedges against regulatory risk and political volatility.
Okay, so the first half of the year is all about hiding in energy and healthcare. But then November hits. The election happens. The votes are counted. The fog lifts. What happens on the trading floor the next morning?
It is a violent rotation. The moment the polls close and the legislative policy direction becomes clear, the institutional risk budgets are unlocked.
Here is where it gets really interesting.
Yeah, the risk premium we discussed earlier, it compresses instantly. That capital that was parked in safe utilities, consumer staples, and defensive healthcare gets ripped out. And it gets rotated aggressively into high beta, growth-oriented cyclical sectors.
Let's define high beta quickly.
Beta is a measure of a stock's volatility in relation to the overall market. If the S&P 500 has a beta of 1, a stock with a beta of 1.5 is theoretically 50% more volatile than the market.
Okay.
When the market goes up 1%, that stock goes up 1.5%. High beta stocks are the growth engines, tech companies, semiconductor manufacturers, consumer discretionary companies. They carry more risk, but they offer much higher reward when the market is rallying.
And the numbers on this post-election rotation are fascinating. From election day through year-end, the leadership completely flips. Information technology suddenly takes the lead, averaging a post-election gain of 3.2% just in that short window. Materials average 2.3%, financials 2.1%, and consumer discretionary 2.0%.
But this rotation is where the real alpha is generated.
I like to think of this whole process like a mechanical spring. Think of the first half of the midterm year like a giant coiled spring. You have all these institutional managers pushing down on the market, compressing it by hoarding cash, reducing their equity exposure, and hiding in boring, safe haven defensive stocks.
Right.
They are building up massive potential energy. The election result isn't necessarily a catalyst for new fundamental growth. The election result is simply the release of the latch. The spring uncoils. The hoarded cash floods back into the market, driving that violent rotation into tech and discretionary spending.
That is a very accurate way to visualize it. The fuel for the post-election rally was actually created by the exhaustion of the first half drawdown.
Ah, I see.
If the market did not panic and hoard cash in Q1 and Q2, there wouldn't be a mountain of sideline liquidity ready to deploy in Q4. The mid-year liquidity vacuum is the mechanical prerequisite for the post-election surge. And we see hedge funds play this rotation masterfully.
Yeah.
Historical data shows that the HFRI Fund Weighted Index, which tracks hedge fund performance, has outperformed a classic 60-40 stock and bond portfolio in 5 of the past 8 post-election periods.
Because they actively pivot. They do not just hold generic index ETFs. They tactically rotate from those defensive anchors into direct policy beneficiaries, like software firms or specific regional financials, depending on who won the election.
Precisely. They ride the uncoiling spring.
But let's bring a dose of reality back into this. We have this elegant, mathematical, 100% reliable, coiled spring. But we do not live in a vacuum. We live in a messy, chaotic world. What happens if the latch releasing that spring gets jammed? What happens when a massive geopolitical shock hits right in the middle of this cycle?
This is where we have to separate the signal from the noise, because external shocks are the ultimate test of the TIV model's durability. While the political cycle patterns are historically consistent, exogenous macroeconomic shifts and geopolitical developments represent the primary drivers of long-term asset pricing.
Let's look at the historical rusted latches. Nicolau pulls data on major military and macroeconomic shocks overlapping with midterm cycles. In 1950, North Korea invades South Korea. The market drops 12.9% in just 15 trading days. In 1962, we had the Cuban Missile Crisis. We were literally on the brink of nuclear war for 13 days in October. The market dropped 6.3% in 6 days. 1970, the Cambodian campaign during Vietnam, a 14.9% drop. 1973, the Yom Kippur War and the Arab oil embargo, a brutal 16.1% drop. 1990, the first Gulf War, Iraq invades Kuwait, leading to a 15.9% correction.
These are terrifying events. When these happen, corporate managers aren't thinking about congressional seat math. They're thinking about global stability, supply chain collapse, and wartime economies.
So how do these shocks interact with our 100% win rate cycle? Do they break the spring?
The conclusion from the data is remarkably consistent. Exogenous shocks do not break the cycle, but they delay the post-election recovery. They absolutely cause severe intra-year pullbacks. That's the mid-year drawdown getting exacerbated by real global fear, but they rarely break the 12-month forward positive trend. Look back at the Cuban Missile Crisis in 1962. It caused a terrifying 26.4% peak-to-trough pullback over the year. But once the crisis resolved, the market rebounded to gain 28.9% in the 12 months after the election. Same with the 1990 Gulf War, a 15.9% correction, followed by a post-election rebound of 29.3% once the conflict stabilized.
It is incredible. It is like the market processes the geopolitical trauma, prices it in, and then the underlying political cycle just reasserts itself like gravity.
Yeah.
But let's apply this to the present day. Let's look at the landscape right now in 2026, because it is acting very strangely compared to the historical average.
Yeah.
Global markets are currently caught in this massive tectonic tug of war.
Yeah, the 2026 anomaly is a fascinating stress test of the typical sector rotation we just discussed. On one side of the tug of war, we have intense geopolitical stress. We have the 12-day war in 2025 between Israel, the U.S., and Iran, which caused a quick 1.3% dip. But the recent escalations with Iran have kept energy prices highly volatile. Brent crude oil is up 20% in the last month alone, and the VIX, the volatility index, has been pushed above 20.
Let's break down why that matters. An oil shock is basically a tax on the global consumer. If gas costs more, people have less money to buy iPhones, go out to dinner, or travel. It is a stagflationary headwind. It scares the central banks, it makes them cautious about cutting interest rates, and it weighs heavily on consumer discretionary spending. That is a massive negative weight on the scale.
That is the geopolitical shock side of the equation. That is the rusted latch. But on the other side of the scale, we have a structural, paradigm-shifting corporate capital expenditure boom in artificial intelligence.
Yep.
We're talking about hundreds of billions of dollars being poured into power generation, data centers, and advanced semiconductors.
And this is where the traditional model is adapting. Normally, in the first half of a midterm year, we should only see defensive sectors leading, we should see energy and healthcare up, and everything else dragging. But in 2026, instead of just defensive sectors leading, both energy and information technology are leading simultaneously.
That is the 2026 anomaly in a nutshell. If we connect this to the bigger picture, you have an overwhelming structural trend fighting a seasonal one. Year to date, energy is up an incredible 29.2%. which makes complete sense given the Middle East tensions and its historical role as a pre-election defensive hedge. But information technology, which is normally a high beta cyclical sector that waits for post-election clarity, is already up 17.1%.
Why is that happening? Why are companies ignoring the political fog when it comes to AI?
Because of the psychology of an existential corporate arms race.
Yep.
A CEO does not care who the president is or what the tax code might be next year if their main competitor is building an AI data center that will render their business obsolete in 18 months.
Right, it's survival.
The institutional fear of missing out on the AI infrastructure build-out, the fear of corporate extinction, is stronger than their fear of congressional gridlock. They are willing to buy tech despite the political fog.
The secular trend is overpowering the seasonal rotation. The corporate resilience driven by AI productivity gains helps explain why major equity indices have remained near record highs in 2026, despite weak household consumer sentiment, a 9.1% peak-to-trough drawdown earlier in the year, and elevated political uncertainty.
Exactly. It shows that while the midterm cycle is a powerful gravitational pull, you still have to analyze the specific macroeconomic weights of the current year.
So, as a listener sitting at home managing your own portfolio, I have to ask you directly, are you holding the right assets, or are you holding the assets the institutions are about to dump? If you are sitting entirely in defensive consumer staples waiting for the election to pass, you might be missing out on this structural AI bid. But if you are entirely in tech, are you exposed to the stagflationary oil shock? You have to be deeply aware of this specific 2026 tug of war.
Which brings us to the most important part of this analysis. How do we actually use this information?
So, what does this all mean? That is the million-dollar question. We have covered 70 years of data, the psychology of institutional hoarding, the academic debate on gridlock, the fama French SMB premium, and the AI versus geopolitics tug-of-war of 2026. How do we synthesize all of this into a workable strategy?
Nicolaus' modern portfolio strategy offers a very clear, pragmatic roadmap. First and foremost, do not try to time the exact election date. Do not try to guess the exact bottom of the mid-year drawdown. Attempting to time the market around specific political events carries incredibly high execution costs and massive risk.
Because if you guess the bottom wrong by a week, you get your face ripped off in the volatility. So what do you do instead?
You use the first half of the midterm year strategically. When political risk is rising and that liquidity vacuum opens up, holding cash is actually a strategic allocation, not a passive one. You use that cash cushion to weather the expected 16 or 17% drawdowns. It protects your capital. But more importantly, it provides you with the dry powder, the liquidity needed to systematically accumulate high-quality equities at lower valuations while everyone else is panicking over the headlines.
You are buying when the fog is thickest, knowing that the mathematical certainty of the cycle dictates the fog will eventually lift.
Correct. And the second piece of the strategy is balancing your factors based on the likely political outcome. If the polling strongly suggests a divided government, meaning gridlock, you need to actively avoid small-cap leverage risk.
Right.
Remember our discussion on the fama French SMB premium and the regional logistics company. Under gridlock, small-cap companies face debt ceiling standoffs and higher borrowing costs. So you underweight small caps and you overweight large cap secular growth leaders who can self-fund their operations.
And what about hedging against the geopolitical shocks?
You hold some cash flow rich energy as a direct geopolitical and inflation hedge. That 29.2% return on energy this year is proof of concept. By combining active risk management, tactical cash utilization in the first half of the year, and balanced factor selection, you can navigate the volatility and position your portfolio perfectly for the historical post-election recovery.
It is an incredibly powerful framework. It takes a terrifying, chaotic year and turns it into a structured, mechanical process. Listeners, I cannot stress this enough. The depth of this research is phenomenal. If you want to stop guessing, stop letting the cable news dictate your anxiety, and start trading with the cycle, check out Nicolo Primavera Carvalho's Technical Intrinsic Value book on Amazon.
It's highly recommended.
And again, for the professionals who want to master this model, get on the waitlist at www.technicalintrinsicvalue.com. It is a rare chance to learn this directly from the source.
It really is a paradigm shift in how you process market information. But as we wrap up this deep dive, there is one final lingering thought that this research provokes, and it goes back to your very first question about why Wall Street hasn't arbitraged this away. This raises an important question about the future of this very cycle.
Oh, where are we headed?
We have just spent the last hour discussing a purely mechanical cycle with a 100% win rate since 1950. It is driven by human institutional behavior, the precautionary hoarding of cash by nervous portfolio managers, and then the rapid release of that cash when uncertainty clears. But we are now entering the era of artificial intelligence and algorithmic trading.
Okay, I see where you're going with this.
These massive quantitative funds deploy machine learning algorithms capable of processing this exact historical data, all 70 years of it, in milliseconds. The provocative thought is this. As algorithmic trading becomes the dominant force in the market, completely devoid of human emotion or anxiety, will these front-running algorithms look at the 100% win rate and start buying the midterm dip earlier and earlier? If an AI knows the market historically bottoms in late Q2 or early Q3, it will not wait for November. It will buy in August. Then another algorithm will try to front-run that one and buy in July. And if they do, will this dreaded election year liquidity vacuum, this massive structural drawdown, eventually regulate itself out of existence entirely? Will the machines smooth out the very anomaly we have been studying?
Wow. If everyone knows the secret, and the machines can execute it faster than we can blink, does the secret stop working? Or does it just happen earlier in the calendar? That is a profound question to chew on. But until the algorithms completely smooth out human psychology, that 19 for 19 record stands undefeated. Remember what we talked about at the very beginning of this deep dive. When you look at an X-ray of a broken arm, it's clean, it's binary, it's comforting because you know exactly what is wrong. But the political noise on TV makes the financial markets look murky and terrifying. What Nicolaus' TIV model does is fix the X-ray machine. He gives you the clarity to see the hidden structure beneath the chaos. The 100% win rate is right there, clear as a jagged white line on an X-ray. You just have to know how to look for it. Thank you for joining us on this deep dive. We'll catch you next time.
That's it for today. I'll see you in the next episode. The Technical Intrinsic Value Podcast is a systematic exploitology to enhance data analysis and delivery. All content logics provided herein are a direct reflection of the opinions value modeled Nicolau Primavera Carvalho. The information provided is for educational and informational purpose only and does not constitute financial, investment, or legal advice. The TIV model is a framework designed to identify patterns based on 15 years of future results. All investments involve risk. By continuing, you acknowledge you are a self-reliant investor responsible for your own execution.